So today people are nervous, and the market is certainly nervous with the 800-point sell-off about what an inverted yield curve means to the future, and are we or are we not heading into a recession? And the answer is, frankly, I have no idea. I'd say there's probably a 50-50 chance that we could be heading into a recession in the next year, but of course nobody knows with any certainty, and economists are certainly conflicted about this issue. So when you hear about the yield curve being inverted, what exactly does that mean? So I would like to think of it as this string here. On the short end of the yield curve, on my left hand, we may have a 1-year note that's paying, let's say, 1.8%, kind of like our US Treasury is right now. Normally what you'd have on the 10-year, you'd have one that's paying, say, 2.5%. And the 30-year of a yield curve on the longer end here, you'd have it paying somewhere around 3 or 3.5%. When you have an inverted yield curve, what's happening is what's been happening over the last few quarters, is that we've had a flattening of the yield curve. What we mean by that is on the one end, on the short end, we have let's say a 1-month Treasury that's yielding 2%. And way out here on the 30-year Treasury, it's also yielding 2%. And you'll hear some economists talking about, well, an inversion of the 2-year and the 10-year has predicted the last 7 recessions. And that's often true. We've already had other, certainly, time frames that have already been inverted. So what's the importance of this 2 to 10-year? Well, really none. What we're expecting and what the bond market is expecting is different from what the stock market is expecting. What the bond market is expecting is that the Federal Reserve is going to be lowering interest rates. So that's why you see the long end coming down lower. And as it's lowering, the Federal Reserve's lowering interest rates, it's expecting these yields to come down. Same thing is happening on the short end, and maybe the Fed gets ahead of this. Maybe the Fed lowers rates and the short end starts to lower, and that we don't have a recession. Certainly many of the economic indicators right now clearly see that the economy is in pretty good form. We have plenty of economic indicators that are doing well. On the other hand, there are some that are certainly slowing. We're certainly seeing slowing growth across the world. And I talked recently in my last video about how tariffs work and the impact of tariffs and the trade war negating the benefit from the tax reform package of a couple of years ago. So what does all this mean for us as far as a strategy? Well, there's a reason why we've been just a little bit above 50% stock in our portfolio. So when we have a day like today when the market's down 3%, our portfolios are only down about 1.2%. And a lot less than the overall market. So some clients may have complained over recent years that we should have been more aggressive with our stance, or maybe had more of our portfolio in stocks. Well, it's important to dampen volatility when it inevitably comes. And the risks of recession have certainly been climbing over the last couple of years. So we've been slowly and steadily de-risking our portfolios and taking some equity off and buying more bonds for our portfolio. So again, does an inverted yield curve guarantee that we have a recession coming? As you hear plenty of pundits get on television, you look at a day like today when the market's down and you'll see the headline that recession fears slam stocks. Well, maybe the stock market now is afraid the bond market knows something that the stock market doesn't know. So stocks will sell off. Tomorrow we could have another rally, a relief rally, and it could go the other way. Or it could sell off further. The reality of it is when you're investing, nobody knows for certain what the market's going to do in the short term. We have to look at ourselves as business owners in those particular stocks that we own, collect the dividends while we wait, live within our means that we're living within from the dividends and not exceed the income from the portfolio. Or if you're like me and still working, then you're reinvesting those dividends when the stock market is selling off at lower prices and you're able to buy more shares for your future income potential generation. So, to get back to the inverted yield curve, does it actually, and with any certainty, guarantee that the market is going into a bear market, or that we're heading into a recession? The answer is no. Does a flattening yield curve mean that? No. Nobody knows for certain what the future holds. So the reality is all we need to do is continue to be patient investors, maintain business, just like I'm not going to sell my business tonight and then buy it back in the morning and then worry about I'm going to look over the next decade, 2, 3, then I'm hopefully still working and still managing portfolios for our clients. I'm not going to worry about the day-to-day. I'm going to put my nose to the grindstone, come to work, not worry about what particular instances is happening, or what there's always something to worry about in the marketplace. There's always something to worry about when you're an investor, and you have to patiently and steadfastly hang in there in difficult market times. I often quip that the most important organ when you're an investor is your stomach. It's not your mind. It's that stick-to-itiveness and the ability to maintain and steadfastly invested long term, rather than worrying about the day-to-day and trying to get in and out of the market, which is a fool's errand. As always, I appreciate all of your concerns and questions. If you have any, as always, feel free to give us a call. And the trust you've placed in our firm is something that we very much appreciate and don't take lightly. So call anytime you have any concerns about your particular portfolio needs. Thank you.